All right, guys, we're going to do a quick video on adjusting entries. This is really, really critical for this test coming up. So make sure you can do adjusting journal entries. That's mainly what I'm going to focus on. This is kind of a little bit more, I guess, focused presentation, just looking at adjusting entries and how you should think through them. So hopefully it's helpful to you. Okay, so basically what an adjusting entry is up to this point, before this point, there was always some type of documentation. We were either receiving cash or paying cash or doing work for someone, or they were sending us a bill or something. There was always external something going on with someone, a customer or someone that we owed money to or whatever, right? But adjusting entries are completely internal. They're not dealing with an external party, okay? And therefore, you will never have cash in the journal entry. There won't be a debit to cash. There won't be a credit to cash. It's completely internal, okay? And it just updates our financial statements to keep track of things that impact the economic entity. Remember, the economic entity is assets equals liabilities plus equity. So it's impacting this equation, but it's not dealing with an external party. So that's why they're internal events. Okay, we do them at the end of the period. Don't get them mixed up. There are other types of journal entries that we do at the end of the period, but adjusting entries are very specific, and don't confuse them with other types of journal entries at the end of the period. And yeah, they're just really important that you know how to do. Okay, really, like every topic that we cover from here on out, there will be a component of it that deals with adjusting entries, and so you've got to learn how to do these. Okay, so you can read through the rest of that. Two types of adjusting entries. There are prepayments. So that's either where we're receiving cash early or we're paying cash early. So if you look at this, so the idea behind this would be prepaid expenses. So that's us paying cash, like think of paying rent early or something like that. Or if we get paid early, we receive cash, but we haven't done the work, we can't recognize the revenue because we haven't done the work. So that's a deferred revenue, or a lot of textbooks will call it unearned revenue. Okay, means the same thing. Now, accruals, actually, let me do something real quick. You don't need to be looking at the top of my hat, right? Okay, so accruals though. Accruals, in this case, we have done the work or incurred the expense, but we haven't received the cash. Let me see here. Yep. So pay or receive cash after the expense or revenue recognition. So wording might be a little challenging for you here, but revenue recognition means we've done the work, right? So the work has been done, but we haven't received the cash. Or if we pay the cash, pay or receive cash after expense, or okay. So if we've incurred the expense, but we haven't paid the cash, that's also a type of, that's an accrued liability. Okay. So we've done the work, but we haven't been paid, or we've incurred the expense, but we haven't paid. Okay. This conceptual part of it isn't nearly as important as understanding how the journal entries work. Okay. And then you also have estimates too. Okay, estimates are for things like depreciation or amortization or something like that. Okay, so this is where the rubber really meets the road. Make sure you can do these. They're worth a lot on the test, and you have to be able to do the journal entries. Okay, probably what I'm going to do the original journal entry. That's the journal entry that we would have recorded when we entered into the agreement or when we did whatever with the external party. So for example, here we purchased. So there was a seller that was selling us stuff, we purchased. So that's the external party. There's a journal entry done at that time. Okay, that's not the adjusting entry, but to teach you guys this concept, like I do that original journal entry first and then show you what the adjusting entry is. The adjusting entry is always done at the end of the period, okay? And that's the one that you'll be graded on your test. You can do both journal entries, but just make sure you do the adjusting entry. Okay. So we purchased $2,000 worth of supplies in July. Okay. So imagine we receive supplies, right? But so purchased $2,000 worth of supplies. So we purchased supplies. I can't remember if we bought them on account or not. So we'll just say cash. Okay. So that part doesn't matter as much. But here we have our supplies that we've bought. Okay. You see how we didn't record that as an expense because the supplies haven't been consumed. Okay. So this is the original journal entry. Now, in this case, they're having us do the adjusting entry at the end of July. Okay. So it could be at the end of the month, or it could be at the end of the year, or at the end of the quarter, or whatever. But in this case, we're doing it at the end of the month. Okay. So if we've consumed supplies now, our supplies account is going to go down. Remember, it's an asset account, so we need to credit that account. And so it's going down. We've used some of them up, and so therefore we also need to record supplies expense. Okay, showing that we showing essentially why this asset account here, this one here, this supplies account, why it has gone down. So we have supplies expense, supplies. Okay, it says we have determines at the end of July they have $1,200 of supplies. Therefore, so 2,000 minus 1,200. So obviously we used $800 worth of supplies, and so that is what our debits for, and that is what our credits for. You see how that balances? Okay, so that's the first one. Okay, we've used up supplies. This is the adjusting entry here. This is what you're required to do on the test. So make sure you can do all of that. And there it is. You can look at the T accounts too. Don't worry about the T accounts for the test. Okay, next one. The beginning of July, we paid $24,000 to the landlord, representing 1 year of rent paid in advance. Okay, so think about this. So in the beginning, we pay cash, credit cash, $24,000, right? We paid out cash, but we haven't used it, right? This is for the full year, 1 year of rent. So we haven't used our rent. So instead, what we want to do is call it prepaid rent. Okay, it's an asset account. We haven't consumed it yet, and therefore we record it as an asset. So this is the original journal entry. Now at the end, so this is the beginning of July. Now at the end of July, we need to do the adjusting entry. And so at the end of the month, here's our adjusting entry. Prepaid rent is going to go down because now we've used a month worth of rent, right? So prepaid rent goes down and rent expense goes up. Remember, an expense account is debited. Okay, again, these things here, that's a D. There's a little dead spot on this thing. AEDLRC. Okay, so remember, these are all normal debit balances. That's how you increase those accounts. And you increase these accounts with credits. Okay, so assets, expenses, dividends are all increased with debits. Liabilities, revenues, and common stock are all increased with credits. In order to record an expense, we debit that account. Okay, prepaid rent is an asset, so we increased it here, but then to decrease it, we need to credit the account. Okay, so this stuff here is still really important. Okay, so rent expense, prepaid rent. Now normally the math isn't hard, right? So we have $24,000, that represents 1 year. So 24,000 divided by 12 gives us $2,000 per month is what the cost of our rent is, and we've used 1 month of rent, okay? Now, on the test, it may be that 6 months have went by, okay? So it'd still be rent expense and prepaid rent, but if it's 6 months, then we would need to go $2,000 multiplied by 6, so $12,000 is what we would have consumed up to that point, okay? But this one here is just for 1 month. Okay, next one, depreciation. Okay, so this is an estimate here. What we're doing is we buy some piece of asset, or in this case, equipment. Okay, so we buy a piece of equipment, and this equipment is going to last a long time. It's going to last 5 years. Okay, so the original journal entry is we debit equipment, and then we credit. We could have bought it on account. It doesn't say, so we'll just say cash. $12,000. Okay, 12,000. So we buy the equipment, we use up cash. These are both asset accounts, right? Then at the end of the month, we need to show that some of the useful life of the equipment has been consumed. Okay, so we're going to credit, we call the account accumulated depreciation, and it'd be equipment. Okay, the reason we use accumulated depreciation instead of just crediting the equipment account is because we want to maintain the equipment account so we can see how much we paid for the equipment. Okay, so credit accumulated depreciation equipment. All this does, this account here, this credit account, it reduces down the equipment account. Okay, so accumulated depreciation equipment, and then debit depreciation expense. Okay, you can abbreviate everything on the test to make it go more quickly. Okay, so then we just need to go 12,000 divided by 5, or 12,000 divided by 60. It gives us the amount of months, which is kind of nice. So normally you just go 12,000 divided by 5, and then divide that by, then you would divide that by 12. So 12,000 divided by 5. Okay, it gives us 2,400, and then divide that. So that gets us to our yearly depreciation, but we're trying to get to monthly. So then just divide this by 12. Okay. Which if you divide it by 60, it gives you the same number. So it's only $200 per month. Okay. Now remember, if 6 months have went by or 8 months have went by, then you would need to take this 200 and multiply it by however many months have went by in the year. Okay. Or if it's a full year, just go 12,000 divided by 5, gives you $2,400. But this here is the adjusting entry for depreciation. Okay. Okay. We subleased a space to a jewelry store. So basically, we rented out this building. We decided, hey, you know, we have extra space, so we're going to rent it out to a jewelry store. Okay. So $500 per month on July 16th. Always be careful with dates. You can see this is in the middle of the month. Jewelry store paid Dress Right $1,000 in advance for the first 2 months of rent. Okay. So the original journal entry is they gave us cash of $1,000. Okay. But we haven't earned it yet, right? Because they actually haven't like started using the space, right? So we had to give them space, but they paid us early. They paid us in advance. Okay, do you see that? So they're giving us cash. Some textbooks will say deferred revenue. Some textbooks will say unearned revenue. This textbook or this PowerPoint here says deferred revenue. I don't know, a lot of times principal students prefer unearned revenue. I'm going to do unearned. Unearned revenue. Okay, this is a liability account. That's why I'm crediting it to increase it. So cash, $1,000, unearned revenue, $1,000. Okay, then as time goes by, so let's look at this. By the end of July, 1/2 of 1 month. Okay, so half a month has went by. It wants us to do the adjusting entry. So now, once half the month has went by, we debit unearned revenue. Okay, so we're reducing that liability account, and then we're going to credit rent revenue. Okay, remember rent revenue has a credit balance. Okay, so to increase the revenue account, we credit it. It's half of a month, and it's $500 per month, so that'd be $250 for half the month. Okay. Remember though, if more months go by, then you would do, bigger numbers. So let's say a month went by, then it would be $500 and under revenue $500. Okay. So that's the adjusting entry. This one here. Do you see how this part here doesn't really deal with the external party? This part here does, right? They gave us cash. We're saying we didn't earn it yet, so we're recording a liability. But here, there's no cash involved. We're just showing for like our own purposes that, hey, we've reduced down this liability here, and we've increased our equity account by crediting rent revenue. That's the logic behind all this. But students struggle with it. It's challenging for them. Okay. Accruals. Okay. So now let's go through and look at these. So we paid $5,000 for salaries for the first half of the month. Assume that the salaries for the second half of the month are $5,500 and will be paid in early August. Okay. So when we have these two amounts, really the only one you need to focus on for the adjusting entry is this one. This one here was paid. Okay. So don't worry about it. So we just need to show that our workers have worked for us, but we haven't paid them yet. So the way we show that is we say salaries, expense, 5,500, but we haven't paid them. So we need to go salaries. Yeah. 500. Okay. And that just shows that we still owe this. This is the liability account that we're increasing. We still owe them that money. We'll pay them next month. Okay. Okay. Unadjusted trial balance, just right, reflects a balance in its notes payable account of $40,000. The company borrowed this amount on July 1st, evidenced by 2 notes, each requiring payment of 10% interest. Okay, so we borrowed money. Back at the beginning of the month, we received cash, $40,000. Okay, and so we had a notes payable. And just do one credit for notes payable, $40,000. Okay, so this is increasing our asset account, increasing our liability account. Okay, but interest doesn't accrue. Like we don't have to start to record interest expense until time goes by. Well, this was done at the beginning of July. Now we're doing it at the end of July. And so 1 month has gone by. Okay, so we need to record interest expense. And then interest payable. Okay, in this case, we only pay, it doesn't say here, notes payable account for 40,000, company borrowed this amount. Okay, it doesn't say when we actually pay the interest, but we definitely have to what we call accrue the interest. So we need to record the interest expense. So you see here, there is no cash here. It's just us showing an interest expense and us showing a liability that we are going to have to pay it. Okay. Now, interest rates, don't worry if it says it's a 3-month loan or 6-month loan or anything like that. interest rates are always stated in annual terms. So this 10%, what I like to do is just go 10% divided by 12. Okay, that'll give us our monthly interest rate. Okay, 0.1 divided by 12 gives us this kind of 0.0083333. And then we take that number and multiply it by the number of months that have passed. So in this case, only 1 month has passed. And then we multiply that by the principal, 40,000. So it's 40,000 gives us $333. Okay. Rounding, whatever you do on rounding is fine. I mean, unless the problem tells you something specific, but I can figure out the rounding. So do whatever makes sense to you. So 333. Okay. Now let's say that like we're doing this at the end of the month. Okay. So July, August, September, October, November, December, 6 months, right? And so, or at the end of the year, instead of doing this here multiplied by 1, instead we would go 0.1 divided by 12. Okay, that gets us to a monthly interest rate. And we'd multiply that by 6 and then multiply it by 40,000. And so this is if it were done after 6 months. And so obviously that would be 2,000. That gives you $2,000 of interest that we would need to record as the interest expense. Okay, so make sure you can do it for multiple months. That's what the test ends up having you do. Okay. So if we loaned another company money, $30,000 that we'd loan them. So think about that. We're giving them money, so our cash is going down. And then we're debiting. In this case, instead of a payable, it's a receivable, right? Note receivable. Okay, $30,000. Okay, so that's the original journal entry. Okay, it was at the beginning of August. This was done. Here, so terms of the note call for payments of principal, $30,000, interest of 8% in 3 months. Okay, so it's saying 3 months, but this interest rate here is still an annual interest rate. Okay, it's always annual. So that's our original journal entry. Our adjusting entry is going to be now we're accruing interest, so we need to debit interest receivable and then credit interest revenue, right? Because we're earning interest as time goes by. I think this is just for a month again. Okay, so it'd be 0.08 divided by 12 to get the monthly amount, and then multiply that by 30,000 to get the amount of interest that they owe us. So 0.08 by 12, multiply that by 1,000, $200. Receivable interest revenue. Okay. You know, if we were doing this, let's say that we loan them money on November 1st, then you'd have November, December, 2 months to get you to the end of the year. So just be 0.08 divided by 12, multiply that by 2 to get 2 months, and then multiply that by 30,000. Okay. So that would be the adjusted, that would be the amount for the end of the year if you're doing 2 months worth of interest. But this is your adjusting entry for 1 month. Okay. Okay, so depreciation expense is a type of estimate. So we base that off of how long we'll be able to use it, and if we think anything will be left over as far as value at the end. of the useful life. Okay. Bad debt expenses, that's an estimate. If we sell things on account, so if a person doesn't have to pay us right off the bat, we have to estimate how much we expect. We have to estimate, sorry, I was looking at an email. We have to estimate how much we expect people not to pay us, essentially. So we don't really have to do that one right away. We'll do that in a later chapter. Okay. And then the trial balance, if you look at this, here is your trial balance. So you do journal entries, you post those journal entries to T accounts, you sum up the T accounts, so then you have the total of every account. You can see all of your debit accounts, all of your credit accounts, and an adjusted trial balance is going to be bigger because it has those different accounts that we had to do adjusting entries for. So like deferred rent revenue, salaries payable, interest payable, things like that. That's it. So hopefully that was okay. Hopefully that was helpful to go through and do it this way. Make sure you can do adjusting entries for the test. Okay. And thank you for watching.